Hello friends and welcome to my YouTube channel Simply Stocks, and today I'm going to talk about Mirza International, one of the shares for which a lot of requests has come in but I was not able to make any videos on it, but here it is about Mirza International. So let's get started. First of all, a disclaimer that this is not a stock recommendation. People taking any position into any share that I talk about should do that with their own due diligence and research, and I'm not in favor or against any company that I talk about. Now about Mirza International. This is a footwear brand that was established in 1979, and they manufacture leather footwear and finished leather products for people of all ages and across the globe. They export the products across the globe. For the last 15 years they have been doing that, and they are the leading suppliers or exporters of leather, you can say shoes or sandals, etc., supplying to 30 countries in UK, US, France, and Germany being their major markets. The market cap of the company is very interesting because the market cap of the company currently is around 750 crores, and the stock has gone down by more than 50% over the last couple of years. The dividend yield is pretty good, and the dividend that they pay is pretty good considering what a small cap company it is. If you look at the financials of the company, then the sales have grown by around 29% when you consider December 20 numbers versus December 19. But look at the PAT growth. The PAT growth has been over 180% at 21.5 crores versus 7.5 crores. And this was primarily due to a slightly lower taxes this time around and stable raw material costs. So on one hand, the sales have grown appreciably, but the raw materials has remained at the same level. So the expenses have curtailed with respect to the amount of the sales that have taken place, and that would definitely show in the bottom line. And that's where all the margins and profitability has kicked in. The only concern in this company is the high debt. The debt has not reduced a lot, and around 200 odd crore debt is pretty high for a company of around you could say 750 crore market cap. So that is a cause for concern. Another point is the return on equity is not great. So if you consider the competitors like Liberty, Relaxo, or Bata, they have a good ROE of northwards of 15-20%, whereas Mirza International currently has an ROE of around 8.3%, which is not acceptable, I would say, for a consumption company. But that is probably why the stock is at what it is currently at, and probably this is opportunity for people to buy. You have to take a risk somewhere in order to make money, and if a stock goes down, it goes down for a reason. Otherwise, you look at other companies, in fact Bata in the same industry, which has been trading at 50-60 times earnings, whereas in terms of Mirza International, it is trading at 15 times. So if you look at the stock performance, stock has done well over the last 1 year, so it has not done badly. In fact, it is near its 52-week high, which is around 68-70 rupees. But stock has fallen over 55% from the highs 2 years back. So in early part of 2018, it was trading at around 142 rupees. Currently, it is trading at 62 rupees. Has been giving strong results. So results have not been that bad. The results have been fine. This quarter results have been exceptional in terms of sales and profitability, but even other results have been quite decent, and it has not warranted the fall, the kind of fall it has had. Probably the fall could be related to the kind of move it had already seen prior to 2018. During that 2015 to 18 period, Mirza International went up by something like 5 or 6 times, and that is probably the reason why the fall took place, because it was extremely overbought at that point of time. Another cause for concern or problem, as I explained, are the return ratios, which have been subdued compared to other companies in the same industry. And but one needs to understand that the promoter holding is strong at around 70 odd percent, which is pretty good, because normally you see in small cap companies promoter holding of between 30 to 50-55% max. But here we have promoters who are backing the company, and you're having 70% high promoter holding, 9 odd percent DII holding, so only 20% free float with the retail investors. Not much of an FII holding. Yes, that is also not quite good. If we would have had around 8-10% FII holding, that would have been better itself. But at 15 times earnings currently, it has corrected over time. I have a feeling that we could see a move in Mirza International in the coming times. Currently, it is trading only at 14-15 times, and if you look at 2 year forward, it is trading only at 11 to 12 times earnings. So, in my opinion, it is a long term buy. There is global consumption play that could take place because the company exports to around 30 countries. And once the global tensions subside with coronavirus, etc., Mirza International should do well. And probably the reason for the fall of the past couple of months could be because of the coronavirus itself. And another reason is because people thought that the numbers might not be good, and once the numbers came in of the December quarter, the stock went up and zoomed at that point of time. Remember that footwear industry will never be out of business, so it is not that it is a cyclical kind of an industry or something of that sort. Once the economy does well globally and in India, this industry will do well, and Mirza International will come up with really good numbers. Yeah, the best thing about the company is the kind of dividend that it's paying, and the valuation that it is at. It is trading at only 14-15 times earnings and not at 40, 50, 55 times. And that is where there is a margin of safety while you buy at around 60-62 levels, which was not there about 2-3 years back when the stock was trading at 130, 140 levels. The sales growth has been appreciable over the last quarter. We have seen a 30% sales growth, and that is quite commendable considering the kind of business environment India is going through. And if you look at the sales to market cap ratio, this is quite trading at around what? One third, yes, 0.33 times sales. So the sales of the company is around 2000 crores, whereas the market cap of the company is around 750 crores. So it is trading at around that point of time of zero point 0.3 or 0.35 times sales, which is extremely cheap in my opinion. If you look at the technicals of the company, then the 200 DMA is very nearby at 57 rupees. There is strong support between 57 to 61 levels, and this is where the stock is currently around 60 to 63. So, very good level to buy at. The breakout is expected above 70, and you could see levels of 100, 110 once that breakout takes place. And remember that the 2 year high of the stock is 142 rupees, so it is way down from that 2 year high, although it is close to its 52-week high. You can buy now with a stop loss at 55. Don't buy the whole bulk, buy as an SIP, and you can have a very good buying price in that way. And remember that there is one concern in respect to the technicals, that is low deliverables. Currently the delivery volume is around 25-26% to 30%, which is not huge. I would have been happy if the delivery volume would have been between 60 to 70%. What that means is that people might still continue to sell the stock, so be wary of it. You can buy big above 70 once there is a good technical condition for it to buy even more, but around these 57-61, just keep on accumulating every month. So what needs to be done? Probably buy as an SIP and keep adding on declines or at current levels. Have a good 5-7 year time frame and keep track of numbers. When numbers keep on coming of this sort, or a 25, 30, 35% growth, then the stock will eventually break out and give very good returns. And kindly have only less than 5% exposure. So this was my video on Mirza International. Please like and subscribe my channel, hit the bell icon so that you can get my videos straight away when I post it. Thanks a lot for watching.